Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's stories with you. We're starting off with a look at the latest developments in the market, where Asian shares are seeing a mixed bag as investors weigh the impact of global economic trends. The U.S. Federal Reserve's recent decision to keep interest rates steady has had a ripple effect on markets around the world, and we're seeing some interesting movements in response. In other news, YES Bank is making headlines after Sumitomo Mitsui Banking Corp raised its stake in the Indian lender to nearly 25%. This strategic move is being seen as a vote of confidence in YES Bank's turnaround story, and analysts are predicting that the stock could target Rs25 in the near term. We'll be keeping an eye on this development to see how it plays out. Meanwhile, the global economy is continuing to navigate uncertain waters, with concerns about inflation and interest rates dominating the conversation. As investors, it's essential to stay informed and adapt to changing market conditions. That's why we're here to provide you with the latest insights and analysis to help you make smart decisions about your investments. We'll be taking a closer look at these stories and more throughout the show, so be sure to stick around. Our goal is to provide you with a balanced view of the market without any bias or agenda. We want to empower you with the knowledge you need to take control of your financial future. So, let's get started on this journey through the world of stocks and finance. We'll be exploring the latest trends, interviewing experts, and sharing our own insights to help you navigate the complex landscape of investing. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and technology, where fortunes can be made and lost in the blink of an eye. Today, we're exploring a fascinating story about three companies that have seen explosive growth since the start of 2023. Let's take a closer look at Palantir Technologies, AppLovin, and Carvana. These companies have been on a tear, with returns ranging from 2,600% to a staggering 7,800%. To put that into perspective, a 7,000 investment in each of these stocks would be worth over $1.1 million today. Palantir Technologies, for example, has seen its revenue soar to over $1 billion in a single quarter, driven by the adoption of its AI-enhanced platform. AppLovin, on the other hand, has utilized AI to revolutionize the advertising technology space, with sales growing 77% year-over-year. And Carvana, which was once considered a high-risk investment, has successfully restructured and seen its stock price skyrocket. Now, it's essential to note that these gains come with significant risks. Palantir's valuation has become inflated, with a price-to-earnings ratio of over 570. AppLovin's valuation is also steep, although its forward PE ratio is more reasonable. Carvana, meanwhile, still faces challenges related to its low margins and high debt load. As investors, it's crucial to approach these opportunities with caution and carefully consider the potential downsides. While these companies have seen incredible growth, there are no guarantees that this trend will continue. It's also worth mentioning that the Motley Fool Stock Advisor analyst team has identified alternative investment opportunities that may be more attractive in the long term. Their recommendations are based on thorough research and analysis, and it's always a good idea to diversify your portfolio and seek professional advice before making any investment decisions. In conclusion, while these three companies have seen remarkable growth, it's essential to approach their stocks with a critical eye and consider the potential risks involved. As we continue to navigate the complex world of finance and technology, it's crucial to stay informed and adapt to changing market conditions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic discussion so far, covering various topics that impact your financial well-being. As we wrap up today's show, I'd like to bring to your attention a recent announcement from Eupraxia Pharmaceuticals. The company has just announced the pricing of its US $70 million public offering of common shares. Now, let's take a closer look at what this means for investors. Eupraxia Pharmaceuticals is a biotech firm that focuses on developing novel technologies to improve drug delivery processes. With this new funding, the company aims to further its research and development efforts, potentially leading to breakthroughs in the medical field. The public offering of common shares is priced at a certain amount per share, which will help the company raise the necessary capital to drive its growth plans forward. This move could be seen as a positive step for Eupraxia Pharmaceuticals, as it demonstrates the confidence of investors in the company's potential. However, as with any investment opportunity, there are also risks involved. The biotech industry is highly competitive and subject to regulatory approvals, which can be uncertain and time-consuming. Additionally, the success of Eupraxia's technology is not guaranteed, and the company may face challenges in achieving its goals. It's essential for investors to carefully evaluate these factors before making any decisions. As we always say on the Riskwiser Zone, it's crucial to approach investments with a critical eye and consider multiple perspectives. In conclusion, Eupraxia Pharmaceuticals' public offering of common shares is an interesting development that warrants attention from investors. While there are potential opportunities for growth, it's essential to be aware of the associated risks and uncertainties. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.